Welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Seema Mody, in today for Bob Pisani, and I'm joined by Jay Jacobs, Head of Research and Strategy at Global X Funds, Jeff Kilburg, CEO of KKM Financial. Stocks hitting the pause button on their record run today, but a big November rally in bond yields could spark the next leg higher. Money has continued to flow into bond funds all year, despite meager yields up 15% compared to flattish flows in U.S. equities. But the spike in yields has some wondering if a great rotation is in the cards. And Jay, could the moves we've been seeing in the bond market be enough to pull money out of bonds and back into stocks?
I think absolutely, at least in the short term. I mean, this has been a fantastic year for long-dated bonds, more than anyone expected, I think. Yeah. And so people are starting to take those profits and move them into equities, where we're starting to see kind of a warming equity market. I think the caution here is some of the equities that are more bond-like utilities, are very expensive. So people should probably look at kind of the lower valuation, kind of cheaper yielding stocks like in financials, where there's better valuations, as a bond replacement. Yeah, it's an interesting point, because at the same time, Jeff, some analysts at Bank of America say this rotation into growth, into value makes sense at this point.
It does make sense. I think a lot of people are talking at this moment in time in Q4. We're confident we're going to get some type of phase one trade deal, but it'll be interesting to see if we can actually have a rotation or simply book profits. We see a lot of registered investment advisors out there, active investors trying to book those profits and find those sectors to rotate into. So last week was interesting. We saw financials really get a jump. We saw industrials really get a jump. But it's interesting about the bond market. I see a cap in the 2% yield in the 10-year note. And a lot of people, if you would have said it was 2019 and that we were still going to be under 2%, you would have laughed at us. So just a year ago, Seema, I think we were sitting here talking about where these bond yields are going, but TLT still is revealing relative strength. We run a lot of ETF model portfolios based upon relative strength, and that strength, yes, there has been profit taking, Jay, when we bounced off that yield down to 150 in the 10-year, but right now it's still exuding some type of strength going into the end of the year.
Are there any bond proxies, Jay, that look attractive to you, especially if the 10-year continues to trade at where it is right now?
Yeah, so we like the preferred space. What you're looking at in the preferred stock market is very high quality US-based financials firms, but they are very well capitalized and they're kind of higher yielding than traditional investment grade bonds. So usually you're seeing 6 or 7% yield with still much better valuations in our opinion than the investment grade bond market.
What is the bond market telling you, Jeff, about what the Fed could do next?
Well, that's the thing that's the biggest takeaway from 2019, because last December, Seema, we saw a very hawkish Fed talking about 3 rate hikes, and all of a sudden a 180 flip, and now we have 3 rate cuts.
How quickly it changes, right?
How quickly it changes, but that accommodative stance, no matter what your view is on the bond market, that has really been relevant. This is the most stimulus we've seen in the system globally, the ECB, Bank of Japan. This is the most money we've seen in the system in 10 years. So I think that money has to work its way through. Therefore, when you look at the 10-year note, being under 2% still in comparison to some of the other foreign sovereign percentages like the German bund, I still think it's still attractive. If we do get to 2%, I think you see that rebalance come back in and buy those treasuries. So the bond phenomena of 2019, I don't think it's over yet.
That's a great point. I mean, on that note, given that the central bank easing has really been a global story, would you prefer U.S. financials, Jay, over their peers in Europe, let's say?
Oh, absolutely. I mean, the U.S. financial system is just so much better capitalized right now and such better strength. It's really a play on the U.S. consumer. We've seen a lot of good expansion of credit, a lot of opening of new bank accounts, things that are a positive for these banks in the U.S., and you just don't see any of that in Europe right now.
The idea, Jeff, that we get back to 3% on the 10-year, does that ever happen?
I think it's a little far-fetched, but I think we'll see it in our lifetime, Seema. But in all seriousness, yes, I think once the Fed really sees what all this money, this flooding of money, they've been involved in the repo market, there's just a lot of pieces of the puzzle we have to see, and I don't think we really are able to understand that or digest that until Q1 2020, maybe even Q2. But right now, it is propelling U.S. equities. We are seeing a small rotation in international equities, because that's been the reversion. You know, do we see a mean reversion? Do we see international equities catch up to U.S. equities? Potentially, but right now, this has been the best game in town.
Yeah, because year to date, Europe is underperforming the U.S., but in the last 1 month, we've actually seen a pretty strong rebound, not just in Europe, but in China as well, Jay.
Yeah, it all has to do with sentiment. I mean, going into the beginning of this year, people were so bearish on Europe, so bearish on China, and it's just not as bad as people expected. So you've seen substantial returns in certain areas in China, like the consumer discretionary sector. You've seen very good returns in Germany, and it's purely just, it's not as bad as we thought.
How much do you think this trade phase one deal is being factored into today's move today?
I think it's a little bit less than I would have anticipated because of all the unrest in Hong Kong. We saw what happened over the weekend. I thought the market could have been down a lot more. So I'm pretty constructive on the market going into this weekend. That's where they're going to be in Chile, hopefully signing some type of agreement. We just want to see some ink on paper, Seema. At the end of the day, that's going to bolster the market and move us higher. I know we're at all-time highs. It seems like every week. We've had 5 weeks in a row in the S&P 500 continue to go higher. But it's all about this weekend because that has been the front.
Well, that summit was canceled, but I guess the big question is where else would they sign that deal since that Chile summit is not happening.